All right, today we are going deep on one of the most important companies you've probably never heard of. Seriously, this is the company that creates the digital blueprints for pretty much every advanced chip in the world. And the reason we're talking about them now is because they just made a wild $35 billion bet that could completely change how we engineer, well, everything. Let's get into it.
But first, we have to start with the puzzle, because at the heart of this whole thing is something that just doesn't make sense. How can a company this critical, one half of a duopoly no less, be trading at half the price of its direct competitor? That's the core question we are going to unpack today.
And look, the numbers here really tell the story. Synopsys and Cadence are the two giants in the world of chip design software. It's a classic duopoly. But check out that forward PE ratio, a key way to measure how a stock is valued. Synopsys is sitting around 30, while Cadence is at a whopping 72. That's not just a gap, that is a canyon.
Okay, so to understand why this huge valuation gap even exists, we first need to look at two massive things that have completely shaken up Synopsys just recently. And this is where the story gets really interesting. First off, this number, $35 billion. That is the price tag for Synopsys to buy a company called Ansys. And look, this isn't just some big deal. It's one of the biggest software mergers in history, and it completely changes the DNA of what Synopsys even is.
So this purchase marks a huge pivot. Before, you could think of Synopsys as being all about designing the brain of a chip, the digital logic, the ones and zeros. But now, after buying Ansys, they're becoming what they call a silicon-to-systems platform. It means they can now simulate how that chip will act in the real world, how it heats up, how physical stress affects it. This is a complete game changer.
The second major event is actually a strategic retreat. Synopsys is choosing to shrink a part of its business called design IP. It's expected to go from 30% of the revenue all the way down to just 18%. Now, why on earth would a company deliberately shrink part of its business? Well, it's because that segment had lower profit margins. They're cutting it loose to go all in on the high-margin stuff needed for AI and super powerful computing. It's a classic case of short-term pain for what they hope is long-term gain.
So with all that context, a massive buyout, and a big strategic pivot, we can finally explore the main arguments from the research report explaining why Synopsys might just be a huge bargain right now.
The case for being bullish on the company pretty much boils down to these three things. They're building an incredible competitive advantage, or a moat. The valuation gap with their rival just can't last forever, and they are perfectly positioned to lead the next big wave of AI. So let's start with this silicon-to-systems moat. You see, the future of chips isn't flat anymore. It's 3D. We're stacking components on top of each other. But when you do that, things like heat and physical stress become enormous problems. By merging its own chip design tools with Ansys's physics simulation, Synopsys becomes the only company out there that can solve these super complex 3D problems all in one place.
And this just lays out the new workflow perfectly. An engineer can design the chip's logic, then immediately simulate how it's going to heat up or bend, and test the whole system digitally before a single physical part is ever made. I mean, think of the time and money that saves. It's incredible.
So let's get back to that crazy valuation gap. The report points out that, for years, Synopsys usually traded at about a 15% discount to Cadence, which kind of made sense because of slightly lower profit margins. But the gap right now? It's sitting around 50%. The argument is that this huge difference is just a temporary overreaction from the market to all the recent changes.
So how does that gap close? Well, the thesis is pretty straightforward. As Synopsys gets rid of that lower margin IP business and brings in the super high margin Ansys software, its overall profitability is going to start looking a whole lot more like Cadence's. And as that happens, the theory goes that big valuation gap should shrink right back down to normal.
And finally, you've got the AI angle. We're moving past AI that just answers your questions. The next big thing is Agentic AI. This is where you have multiple specialized AIs that work together on their own to solve a problem. So for example, an AI that's an expert in heat management could automatically negotiate with an AI expert in power usage to design the perfect chip, all without a human needing to step in. And Synopsys is right at the forefront of this tech.
But of course, no deep dive is complete without looking at the other side of the coin. A $35 billion bet and a huge business shift, they don't come without some serious risks. So what could actually go wrong here?
The risks are really just the flip side of the promise. The dream is this unbeatable moat, but the risk is a messy, failed attempt to merge two giant companies. The promise is better profits down the road, but the immediate risk is a painful slowdown in growth while they restructure. It all comes down to execution.
And then there's the elephant in the room, geopolitics. Chip design software is a huge strategic choke point in the tech rivalry between the US and China. And as the report points out, Synopsys felt this firsthand not long ago when it had to pull its financial guidance after getting a sudden letter from the US Commerce Department. Now that specific problem got solved, but it's a stark reminder of how vulnerable the company is to government actions that can literally erase revenue overnight.
Okay, so after weighing the incredible potential of this new silicon-to-systems beast against some very real risks, what's the final call from the research, and what should we be watching for next?
The report's conclusion is clearly and strongly bullish. It basically argues that the market is way too focused on the short-term headaches of the merger and is completely missing the massive, long-term advantage that the Ansys deal creates. In short, it sees the current stock price as a market mistake.
And it lays out a really clear timeline of events to watch. The Q1 earnings release in late February, that's going to be the first big test. Then the company's Converge conference in March will be their big moment to show off the new combined technology. And by late 2026, we should have a good idea if that shrinking IP segment has finally bottomed out. These are the moments that could make the market take a second look.
So it really all comes down to this. The entire investment case here is built on the idea that the market made a temporary mistake, that it's punishing Synopsys for short-term uncertainty while totally ignoring a fundamental shift that makes the company stronger for the future. The ultimate question, of course, is whether the market will eventually agree.